What can I say? What can I say? Plurilock stock is on fire, isn't it? One day today, 34%. It's just incredible. I'm stunned. I'm stunned. So let's take a look at this. From the bottom in April, it was 20 cents. Now we're up almost 300%. Welcome to the microcap space. When they finally move, and they leave you in the dust. So look at this chart, how bad it looks, a 5-year chart, right? And now look at this. Look at that recovery. It's just incredible. So now people are asking, is this going to last? Where is it going? I don't know. I don't know in terms of, I can't tell you what it's going to do tomorrow. But what I can tell you is, let's take a look at the valuation. Let's take a look at the valuation and see what it means. As of now, the market cap is $30 million, right? I want to show you this list. Public company trading data for cybersecurity companies. So there's a list of cybersecurity companies. And if we look at the valuation in terms of market cap or enterprise value over revenue. So you can see multiples. I'm just going to look at this data here. 1.8, 7.5, 1.5, 6.7, 17. Palo Alto, I made a video about this. 17, right? 16.8. And how does Plurilock trade in relation to this? Well, I just showed you the market cap is about 30, and then the revenues for last year were 70. Right? 70, 30. So after going up 300%, the market cap is still like 40-something% of revenues, right? But now, this is a little misleading to just take this data and say, well, Plurilock should be trading at the same revenue multiple, because gross margin is very important here. A lot of these companies have a very good gross margin profile because they're selling software. Software has incredible margins, right? Like, look, 89%. So when you have incredible gross margin like this, yeah, your company deserves to trade at a very big multiple. Plurilock is in a VAR business, value-added reseller, and that business is a low-margin business. Now, the critical services is a higher margin business. But overall, based on Q1, Plurilock had gross margin of about 20%. So 20% is not as good as 80%, right? So let's find a comparable that's closer to that 20%. So if we go down the list, we can see 35% here, right? What is that company? Well, that company is Telos. And Telos is trading at, it says here, 1.2 times revenues. Telos, even though right now Telos has a better gross profit margin than Plurilock, it gives you an idea where Plurilock should trade around, because Plurilock has about 400, 500 clients, and only about 10 of those clients are getting a critical services business or services. And just those 10 is enough to make the margins for the Q1 in the range of 20%. So where would those margins be if Plurilock had, 100 of them being clients of critical services? Would we be closer to that 35, 36%? I think so. So it's a good one to look at, right? So let's look at Telos, what kind of market cap it has and what revenues it has and whether it's profitable, okay? So here it is. Market cap 265 million. 265 million. Revenues 145. And those are declining revenues because they were 216 million, now they're 145. So what was it again? 265 divided by 145. 1.8, so almost 2 times revenues. Now, are those revenues profitable? No, they're losing. They're losing $34 million per year. So the company doesn't have to be profitable to have a good multiple, right? So, but now what's the difference? Well, this company is trading on NASDAQ. Plurilock is not trading on NASDAQ. But that's the arbitrage because most of the revenues for Plurilock are in the US. So what happens? What happens when Plurilock lists on NASDAQ? Because remember, those revenues, 145 million, they're about just double. They're about just double what Plurilock has. And yet the market cap of Telos is about 10 times. See the disconnect? So if we took that multiple of 182 and applied it to Plurilock's revenues, which were 70, we're talking about Plurilock should probably trade about 130 million market cap. And what does it have? 30, right? And I know there's going to be more shares issued when warrants get exercised, but I'm trying to keep it simple. So it should trade about 130 if it was on NASDAQ. Again, the arbitrage. The market cap is about 30. So in order to trade at a similar level, the stock would have to be 325. So from this level, it would have to be at 325, right? And you can argue that Plurilock should have a multiple higher than this company for many different reasons. Clientele, also Plurilock is not losing even close to this amount of money. But I wanted to show you this because this is a very good comp, okay? This is a very good comp, and I don't think people truly appreciate what they have with Plurilock. They're just have blinkers on and they can't see the vision. One arbitrage is when they uplist to the US exchange, which it's inevitable down the road because most of their revenues are from US. Why would they be trading in Canada, right? It's inevitable. And also, you have something when a business passes the 100 million mark in revenue, it gets re-rated based on scale. So for example, when a business has 10 million of revenues and everything else stays constant, that business might trade for 50% of revenues or less. When that business reaches 50 million, it might trade for 75% of revenues. When that business reaches 100 million of revenues, it might trade for 1.5 times revenues. When it reaches 300 million, it might trade for 4 times, depending on the size, right? So when Plurilock's market cap gets adjusted or revalued, and I'm not talking about getting overvalued. Plurilock is severely undervalued based on the competitors, based on what it can do, based on the fact that it can uplist to the US. It's severely undervalued. And the stock is soaring right now because the message is getting across and people are buying the stock because it's easy to buy it. It's right in front of your face. But when, let's say, the market cap gets to a level where it trades reasonable, meaning more than 1 times revenues, 1 times or 1.5 times revenues, or 1.8 with the example of a competitor, then what Plurilock can do is acquire smaller companies for 0.5 or 50% of revenues, 0.5 of revenues, take them onto its own platform, and then those revenues get re-rated because those revenues are now part of a bigger company. So you buy at 50% of revenues and you get re-rated at 1.5 times revenues, and you can do it over and over and over. You reach 300 million mark of revenues, and now your revenues might be worth 5 times, and then eventually you might get bought out, right? So that's the vision, right? But I wanted to show you that just because the stock is soaring, just because it's up 35%, that doesn't mean it's overvalued. It might still be severely undervalued. And looking at the competitors and looking at this competitor that only has doubled their revenues and yet 10 times, almost 10 times the market cap, and the only difference is it's trading on NASDAQ versus trading on TSX Venture, you know, that screams opportunity, right? And that's why the stock is going up, and that's why people are paying attention to it. So that's all I have for you today. What's going to happen tomorrow? I don't know. But all I can tell you is value versus price. Warren Buffett always says, price is what you pay, value is what you get. Now, what kind of price you're going to get tomorrow? I don't know. What kind of price you're going to get next month? I don't know. But I focus on the value, and as long as I get more for my money than what I'm paying for, you know, I'm pretty happy with the scenario. Thanks for watching.